Okay. The financial management team of Tampen PSA is discussing how the company should appraise new investments. There is a difference of opinion between two managers. Manager A believes that the net present value should be used as positive NPV investments are quickly reflected in increases in the company's share price. Manager B said that NPV is not good enough as it is only valid in potentially restrictive conditions and should be replaced by APV. Tampen has produced estimates of relevant cash flows and other financial information associated with a new investment. These are shown below. We have investment pre-tax operating cash flows from year 1 to 4. Note 1 is the investment will cost 5.4 million payable immediately, including 600,000 for working capital and 400,000 for issue cost. 300,000 of issue cost is for equity and 100,000 for debt. Now, don't misinterpret this. This investment will cost in total, it will cost 5.4 million. Out of this 5.4 million, inside the 5.4 million, we have 600,000 for working capital, we have a 400,000 for issue cost. And out of the 400,000 for issue cost, 300,000 represent issue cost on equity, while 100,000 represent issue cost on debt. Issue costs are not tax allowable. Issue costs are not tax allowable. You can see the instruction. Issue costs are not tax allowable. The investment will be financed 50% equity, 50% debt, which is believed to reflect its debt capacity. Expected company gearing after the investment will change to 60% equity, 40% debt by market value. So you can see that. So this is the point that even though the question does not ask me to compute adjusted present value, this point will allow me to know that this question is better solved using the adjusted present value approach. Because the question has told me that I'm going to take on new capital to finance this project, and that capital I'm taking is going to change my journey to 60% equity and 40% debt. Okay, so information 2 and 3 confirm to me that the adjusted present value is the more appropriate, even though that the question has already told us to compute NPV and APV due to the argument between the two directors. The investment equity beta is 1.5. The investment equity beta is 1.5. Debt finance for the investment will be an 8% fixed rate debenture. Capital allowances are at 25% per year on a reducing balance basis. The corporate tax rate is 30%. Tax is payable in the year that the taxable cash flows arises. The risk-free rate is 4% and the market return 10%. The after-tax realizable value of the investment as a continuing operation is estimated to be 1.5 million, including working capital at the end of year 4. Working capital may be assumed to be constant during the 4 years. So calculate the NPV and APV of the machine. Now let's calculate the NPV first. Let us calculate the NPV first. Open that. Let's see the computation of the NPV of this. Okay. Now we have our investment pre-tax cash flow. We have investment pre-tax cash flow. I actually solved this question that will not waste much time. when we are discussing it, because we did not hold class on Monday. And hence what I'll be doing that so that it can hasten up our discussion. Now, this is our investment pre-tax. You can see the name is what? Is pre-tax. These cash flows are pre-tax. It means we have not paid tax on them. We have not paid tax on them. So what do? We need to charge our tax. So that's what we have here. It's our investment pre-tax. It's our investment pre-tax. Now, don't forget that you can compute your tax in two ways. Either you deduct your capital allowance or you do tax saving or capital allowance. All these ones are not new to you. So apart from that investment pre-tax cash flow, you see that there's no any other item that represent inflow. No any other item that represent operating flows. Therefore, that's going to be taken as our profit. Now, let's go and compute our capital allowance. We compute our capital allowance and use it to reduce this profit so that we get our taxable profit before we compute our tax liability. Now, what do we have? This is our investment. Our investment is 5.4 million. But out of this 5.4 million, we have 600,000 for working capital. We have 400,000 for issue cost. Of course, we cannot claim capital allowance on working capital because working capital is not an item of non-current assets. Okay, it's not a non-current asset. Therefore, we can't claim capital allowance on this 600,000. Likewise, we cannot claim capital allowance on issue costs. We can't claim capital allowance on issue costs. So these two items will be eliminated from this 5.4. 400 plus 600 will be 1,000. So remove it from 5.4. It means the amount on which you can claim capital allowance is just 4.4. So we go there, we compute our capital allowance. Let's see where we have it. You can see it. Capital allowance for the cost at the beginning. Capital allowance is 25%, reducing balance. That gave us 1,100. So 25% of that. Sorry, yeah. 25% of 4.4 is what gives us 1,100. The tax written value is now 4,400 minus this. We get this. That is 25%. We get 825. Then for year 3, we have this as a tax written value. That is 25%. We have 618.75. And the tax written value in year 4 is 1856.25 times 25%, giving us 464.06. These are the capital allowances. These are the capital allowances. I deducted them from so the deduction here. This is Angela's left again. Now, these are the capital allowances. When I remove my capital allowances from my pre-tax cash flow, I get my profit before tax. That's taxable profit. That gives me my taxable profit.
So please bracket your capital allowance so that we'll...
Okay.
In case we forget.
No problem. Let me put it in brackets. Put them in brackets. Yeah. So that gives us our taxable profit. That gives us our taxable profit Now our tax are 30%. We give out this figure. I don't need to waste time on those ones. I don't need. Then because this allowance is no cash item, I'm adding it back. Add back capital allowance. Is there anybody who does not understand this rule? 1 minute, please. Is there anybody who does not understand that rule? I can hear you. Speak up. Is there anybody who does not understand it? Is there anybody who does not understand it? No. Okay.
Which one?
How we got from the beginning to where we have this.
No problem.
Highlighted. Look at it, Mrs. Angela.
No problem. No problem.
Okay. Now, our investments. Now, you notice that here, I did not use, I didn't use, what we call it, 4.4. Let's go back to that question and see everything that should look at it. Okay, I think it's down. You see that in this one now, the only thing I remove is 600,000 working capital because working capital is a separate line item. Okay, if you include it, fine, but it's still going to add up to the same thing. I have decided to separate it. However, your issue cost, when you are dealing with NPV, where you are computing NPV, your issue cost is part of your investments. Okay. Initially, this question is not supposed to be solved using NPV at all. Okay. It's not an NPV question. That's the truth. It is not an NPV question. But because of the argument between the two managers, that's why the question is saying, okay, compute NPV and also compute APV. Ordinarily, it is not an NPV question. Now, but in a question of this nature, where you are asked to solve an APV question using NPV, the issue cost should be part of your investment, okay? It's part of your outlay. That's what I'm trying to say. So that's how we have our, where do we have it? You can see,
But
I have my investment.
But it was not person wanted to calculate capital allowance.
Yes.
Why is
because
that?
you can't claim capital allowance on it.
Okay.
Person, it's an issue because it's more or less like an expense. Do you understand?
Yes, sir.
Okay. So this investment will be sold at the end of the 4-year life of the project at 1.5. So that's how you have it as an inflow here. And our working capital is one of, let's see, 600,000 for working capital. So that's the only working capital we have. And there is no inflation. I didn't think there is inflation now. We'll have inflated the cash flow, the working capital, including all the cash flows. But there is no inflation. And we're only given one working capital. So that working capital will be in year 0. What do you notice here? You will notice that I did not recoup my working capital, right? I did not recoup my working capital. Why? The reason why I did not recoup my working capital is that if you look at what the question says here, okay, I think it's down. The after-tax realizable value of the investment as a continuing operation is estimated to be 1.5 million. Now, this is the sales proceeds of the investment as a whole. Sales proceeds of the investment as a whole is 1.5. Now, you cannot sell a company and still realize working capital separately. The moment you sell the company or you sell the investment, everything concerning that investment is already part of your sales proceed. So in that case, you don't recoup working capital. Let me repeat it. We are selling this company as a whole, and we are told that the sales proceed is going to be 1.5 million. So in that sales proceed, working capital is already inclusive. So you cannot recoup working capital separately in a question of this nature. The way you see this information that, oh, maybe the investment is going to be sold as a going concern. That's another name they can give to it. They can tell you this investment will be sold as a going concern or as a continuing operation. So going concern and continuing operation, they mean the same thing. Okay. So in that case, please don't recoup working capital. Don't recoup working capital. That's the reason why I did not recoup working capital here, because it's already part of my sales proceed. Now, when we sum all this together, we get our net cash flow. We get our net cash flow. And what is our WACC? We are given the investment beta. What is the investment beta? The investment beta is 1.5. The investment beta is 1.5. So I can compute my cost of equity using this 1.5. Look at it. It's not a proxy beta from the name, please. Look at it. The investment beta. The question did not tell you a proxy beta. It's an investment, but that investment, the beta of that investment is 1.5. That's what the question is saying. So we can pick that beta and compute our cost of equity. And of course, the question has indirectly gave us cost of debt A by giving us this 8% fixed rate. Okay, by giving us this 8% fixed rate, we are already given the cost of debt. So we know our cost of equity, we know our cost of debt. We can go ahead and calculate our WACC. The only thing you do to this cost of debt is what? Just adjust it for tax. That's all. And that's why we have down there, see there, WACC. Cost of equity, risk-free rate, beta of equity, market return risk-free rate, that will give us 30%. Cost of debt, that's 8%, 1 minus tax rate, that gives us 5.6%. Then put this in the WACC formula. Cost of place, the gearing you are going to use is the gearing after the investment, not before. Okay, you will only use, okay, when we get there, I will explain. When we are doing NPV, I want to calculate WACC. The gearing you are going to use is the gearing after the investment has been financed, because that is the gearing that will reflect the additional money brought in to finance that operation. That is the gearing you are going to use. So our gearing, we are told in the question that is going to be what? Gearing is going to be, where do I have it? 60% equity, 40% debt. 60% equity, 40% debt. And that's why I have here. You can see it? I have it here. 13% times 60 over 100, that's 60 plus 40, 100. 5.6 times 40. So all in all, my WACC is 10. My WACC is 10. So I use it to discount this. I use it to discount the cash flow. Okay, I use it to discount the cash flow. I have my present value. I have my present value. So my NPV is 1,387.66. That is the NPV of this project. That's the NPV. What do I put it? Any question on this?
No, sir.
Mrs. Angela.
I'm still copying.
Okay. Mrs. Shi, are you done copying?
I'm not going. I will solve it myself later. You send it to us. Yeah. So
What is
please
it?
send the notes to after the class. I'm not copying. I'm just listening.
Okay.
I'll solve it later. I just want to listen for now.
Okay, how can I help? I'm here to want you to be survived. I've never so much killed this.
Let me call this woman again.
Suddenly you're here.
What happened? No. She's not even picking call at all. What happened?
I can't watch you. She's my fiancée. I'm a friend. Never you in your miserable life set your feet in this house again.
You know the man now. Oh, you're working. Okay. Oh, my video.
Mrs. Angela, you are disturbing the recording of this. You are disturbing the recording of this video. All right, shall we continue? Are you done? Okay, let us continue. So I will share the material with you so that you can copy, so that we don't waste time. Now, the adjusted present value. The adjusted present value. The only thing that will change in the adjusted present value is that you know that the rule of adjusted present value is that we are separating investment cash flow from financing cash flow. If you go through what we did, the explanatory note, you see that I explained that the adjusted present value will separate investment cash flow from financing cash flow. If that is the case, it means that the issue costs we have here, the issue costs are included here. That 400,000 should not be included because it is a financing cash flow. Okay, it is a financing cash flow, so I will remove the 400. That's the only thing. That one and the cost of capital. These are the two that will change in the computation of adjustment. All other things, all other cash flows remain the same. Okay, all other cash flow remain the same. You can see that instead of 4.8, I have 4.4.
Yes,
it's because that issue cost up there is a financing cash flow. It's not an investment cash flow. So it is not proper for you to include it in adjusted present value calculation. Do you understand?
Yes, sir.
So we now go and compute what type of work cost of capital do we need? We need cost of capital of an on-J company, cost of equity on J, right?
Yeah.
So what do we need to do? It means that beta given to me, I need to go and on-J the beta. You see that? The investment beta is 1.5. Now I need to on-J the beta using the gearing before the investment. That's what I said earlier. When you are on gearing, you use the gearing before the investment. But when you are regearing, you regear using the gearing after the investment. However, when you are doing APV, you don't need to regear. If you regear, your solution will be wrong. Your solution will be wrong. So on gear, we have this. This is the gearing before the financing. It was 50-50, but after the financing of the project, it will now change to 60-40. So 1.5 times 50 over 50. What am I doing? Yeah, it's correct. Over 50 plus 50, 1 minus 0.3. So when we evaluate that, we have 0.88. This our asset beta. So I don't need to reject because I'm doing APV. I don't need to reject. What do I need to do? I just put it in CAPM. I just put it in CAPM. I put it in CAPM. So my cost of equity on here is 9%, 9.3 actually, but I can round it up to 9%. I can round it up to 9%. So that's the 9% we use here to evaluate. Instead of 10%, it's now 9%. And our base case NPV is 896.91. Look at this very well. Is there any question on that? Do you have a question on that? Is it clear?
No, sir.
Mrs. Angela, are you fine? Mrs. Angela, are you fine?
I'm
Okay.
fine.
All right. So that is our base case NPV. We now need our finance effect cash flow. I've given you the template that we have to follow. The first one is what? Finance requirement. And the question has told us, look at it, that the project is going to be financed 50% by equity and 50% by debt. Look at it. The investment will be financed 50% equity, 50% debt. What's the total financing? 5.4. So I will divide that 5.4 by 2. Okay, I will divide it by 2. That's what I have here. 50%, 2.7, 50%, 2.7. The total is 5.4. That's the first step when you are sorting your finance effect cash flow. Our issue cost, the question says that issue cost is 300 for equity, 100 for debt. Total is 400, and it is not tax allowable. So I'm not going to charge tax on this. Now, issue cost is year 0 cash flow. Don't forget. Issue cost is year 0 cash flow. So let me put year 0 there. The year 0 cash flow. Now, because issue cost is not tax allowable, I'll jump to the next one, which is tax saved on interest. This is the reason why I gave you that template. The moment you follow that template, I don't think there's going to be any difficulty that I'm going to face on adjusted present value. I don't think so. I don't think so at all. You can follow the template. So tax saved on issue cost. Tax saved on interest. Our interest is going to be on debt, not on equity. You don't pay interest on equity. So we are paying interest on 2.7, which is our debt. And the interest rate is 8%. 8% of 2.7 is 216. Okay, so tax at 30%. That's 30% of the interest rate. The interest is 216. So multiply by 30%, we have 64.8. We have 64.8. 64.8 is our tax saved on interest. That's all. We don't have subsidized loan. Can say we don't have subsidized loan. So issue of a tax save or net savings on subsidy will not come up. So in this item, in this question now, I only have issue cost and tax saved on interest. That's all. Instead of issue cost, tax saved on issue cost, tax saved on interest, and net savings on subsidized loan. Instead of 4, I'm having just 2. So tax saved on issue cost and tax net savings on subsidized loan are not applicable to this question. So I cannot do my summary. I told you that all these cash flows, now this one is going to be from year 1 to 4. Year 1 to 4. I told you that the finance effect cash flow, you can discount it using cost of debt or risk-free rate. What's our risk-free rate? You can use any of your choice. Don't say which one is more appropriate. There's no one that is more, no one is more appropriate. It depends on your choice. Although you can go for cost of debt, because you can say, oh, maybe you are dealing with finance and debt should be more synonymous of finance. But that does not mean that is superior, or a person that's used cost of debt will get more mark than a person that's used risk-free rate. It is your choice. It is your choice. So issue cost year 0, physical factor year 0 is 1, times 400 is 400 negative. Now, tax save on interest is 64.8. Please, I don't know which one I use. Every calculate annuity factor 4% year 1 to 4, whether you get 3.6. Let me calculate it. Do you have 3.6? I'm not with my calculator, really. Are you there?
Yes, 3.629.
So
3.630. Yeah.
exactly. So I use risk-free rate. You can see that. If you use cost of debt, you are correct, but your result will not be this, but you are still correct. Okay, you are still correct. That is one of the weaknesses of adjusted present value. The discount rate for discounting the finance effect cash flow is highly subjective, as 2 different rates can be used, either risk-free rate or cost of debt. Okay. So our adjusted present value is negative 106.69. Now the question says you should explain the validity of the 2 directors. Of course, for you to use NPV, number 1 is that your financial risk must not change. The investment must not result in changing of your financial risk for you to use NPV. If you are doing an investment that will change your gearing ratio, then NPV is not appropriate. So if manager A is saying we should use NPV, then that assumption is not correct, because this project we are borrowing, and the borrowing will change our it will change our journey to 60-40 from 50-50. Therefore, the more appropriate technique is adjusted present value techniques, and that is in favor of manager B. So that is question number 26. Question? Any question? Oh,
Okay.
we should continue, Abby.
Continue, sir.
Good. So let us go to the next. You are going to decide something for me now. You are going to decide something for me now. Let me tell you. This question here, question 27 for Buki, was this is the question that I can apply in November 2019. Okay, this way I can copy the question that they use in question number 1 of November 2019. And of course, it is not likely that this question will be repeated again. Now, when you look at the next question, this next question also is from where I can always pick their question, though that question has never been tested by ICANN, but it has been tested by ACCA. It has never been tested by ICANN. So which one will you choose? I don't want to solve the two. I don't want to solve the two. I want to solve one. You will now pick, do we solve question 27 or do we solve question 28? Pick one for me and we'll solve it together.
Well, for me, the one that has not been tested, 28.
Mrs. Angela, which one do we solve?
Same here. Same.
What do you say?
I think she said
Tested.
Okay, so let's solve question 28. Let us solve question 28. What is the requirement? Calculate, that's requirement A, calculate the adjusted present value, APV, of the project, correcting any errors made in the net present value estimate above, and conclude whether the project should be accepted or not. Second requirement, show all your relevant calculations. B, comment on the corrections made to the original net present value estimate and explain the APV approach taken in part A, including any assumptions made. Okay, that's the requirement. Let's read the question together and try to understand the content. You have recently commenced working for Franco Limited and are reviewing a 4-year project which the company is considering for investment. The project is in a business activity which is very different from Franco Limited current line of business. So this has confirmed to us that business risk will change, right? That has confirmed that business risk will change because this project is going to be in an entirely new industry. The following net present value estimate has been made for the project. Let's see the estimate. Sales revenue, direct project cost, interest. Without telling you, how do we treat our interest in cash flow? In our, not normal cash flow now, in our net discounted technique, how do we treat our cash interest? How do we treat it? Interest. How do we treat our interest? We included in our APV or MPV. I want to hear your opinion.
APV.
Do we recognize interest when computing either APV or MPV?
no, sir.
Okay. When we are doing MPV, interest is not recognized. And the reason is that the interest is already used to complete our work. So interest is ignored. But if you are computing your APV, for APV, we are not using work to discount base case MPV. We use cost of equity on JED. Therefore, interest is not recognized yet. But interest is a financing cash flow. It's not an investment cash flow. Therefore, the interest will be taken to finance effect cash flow. You understand? So when we are doing APV, interest will not be included in base case cash flow. It will be included in finance effect cash flow. So we have investment/sales, we have cash flows, which are net cash flows. We have discount factor 7%. Then we have a present value. Now let's look at the notes to the question. The net present value is negative 1.65 million, and therefore the recommendation is that the project should not be accepted. In calculating the net present value of the project, the following notes were made. Okay, let's see the note one by one and try to discuss them. Since the real cost of capital is used, please pay attention. Since the real cost of capital is used to discount cash flows, neither the sales revenue nor the direct project costs have been inflated. It is estimated that the inflation rate applicable to sales revenue is 8% per year, and to the direct project cost is 4% per year. Do you think that the current treatment is correct? Hello? Is the treatment correct? I believe you can see the question now. So look at it. Is that treatment correct? Just speak up. We don't know, Abby. Are you with me? No.
It's just about, I'm trying to understand what the question.
You really want to interpret it. You are Mrs. Angela. You have to interpret this note one to me. You really want to interpret it. I'll not interpret it for you. Look at the treatment they gave to that particular item right now. Is it correct or not?
Can you scroll down? Let's see the treatment they gave.
This is it now. Look at what the question says now. That's it. Read the statement and see whether it is correct or not. They are telling you how they got this NPV, this revenue, and cost of sales. These two, the figure we have there. That's what note one is giving, is telling you how they arrive at the figures. So I'm not saying, do you think it is right? Do you think it is right? No, guys, I'm hungry. That's why I'm hearing you. I don't finish me. You don't know, Abby? Okay, let me explain. Since the real cost of capital is, okay, what is the rule for discounting cash flow? When you want to discount real cash flow, what type of cost of capital do you need?
You need real cost of capital.
If you want to discount nominal cash flow, what type of cost of capital do you need?
Money cost of capital.
Good. But there is a situation where I said you can leave your cash flow in real, Abby, that maybe they give you real cash flow, they give you inflation, and they give you money cash flow. I said you might not convert your cash flow to nominal. You just go and convert your nominal cost of capital to what? To real. Abby, what is that situation? I said, where you have all your cash flows being subject to one inflation rate, you have revenue subject to 2% inflation rate, for instance. You have cost of sales subject to 2% inflation rate. You see that both of them are having the same inflation rate affecting them. In that case, I can leave my cash flow in real. I will now convert my cost of capital from nominal to real and discount. But look at this question. Is it the same? Do we have that condition here? You see that inflation rate of revenue is different from, what do you say?
The rates are different.
Exactly. And the moment you discover that your rates are different, then you cannot use real cost of capital. Look at it. They use real cost of capital, even where revenue and cost are having different inflation rates. That is wrong. These are the errors that the question wants you to spot. Okay? These are the errors that the question wants you to spot. Okay. So we have seen one error now, a bit two self, the interest and this one. We have seen two errors. Okay, let's continue. The project will require an initial investment of 38 million. Of these, 60 million relates to plant and machinery, which is able to be sold for 4 million when the project ceases, after taking taxation and inflation impact into account. Tax allowable depreciation, that's note 3. There's no problem in note 2. No problem. The only thing here is that you are not going to compute balancing adjustment. Let's continue. Tax allowable depreciation is available on the, okay, I've read that. Tax allowable depreciation is available on the plant and machinery at 50% in the first year, followed by 25% per year thereafter on a reducing balance basis. A balancing adjustment is available in the year the plant and machinery is sold. Frenco Limited pays 20% tax on its taxable profit. No tax allowable depreciation is available on the remaining investments. And they will have nil value at the end of the project. So basically, that is information on capital allowance. I don't have any issue with that. Note 4. Franco Limited uses either a nominal cost of capital of 11% or a real cost of capital of 7% to discount or to discount all projects. Given that the rate of inflation has been stable at 4% for a number of years, interest is based on Franco Limited normal borrowing rate of 150 basis points over the 10-year government yield rate. When we get there, I'll explain that. At the end of each year, Franco Limited will need to provide working capital of 20% of anticipated sales revenue for the year. Any remaining working capital will be released at the end of the project. Okay? No problem with that. That's information on working capital. Then we have working capital and depreciation have not been taken into account in the net present value calculation above, since depreciation is not a cash flow and all the working capital is returned at the end of the project. So let me look at this and tell me what is wrong here. What is wrong? Please look at it very well so that at least you get yourself used to questions. What is wrong with that, with the treatment of working capital and what do you call it, depreciation, if any? If there's nothing wrong, just let me know that there's nothing wrong. If there's anything wrong, let me know, okay, this is what is wrong. Look at it very well. Is there anything wrong? Mrs. Shim? Mrs. Angela?
Yes, sir.
Is there anything wrong? Look at the treatment. I think the question has stated it. Is there anything wrong with that treatment?
Which one, sir? Is it note 7?
You said?
Is it note? Which one are you talking
What?
about?
The one I highlighted, note 7. Note 7, the one I highlighted here.
Where is the net present value? Which one are they talking about?
What the computer there now? See net
Where
value.
is it now? Not seeing it. Okay.
The computer net present value here now.
Okay, let me
Eh?
look at it. So let me look at it. So I've not seen it.
I would advise you.
This is.
I'm not seeing the screen. I can't see.
You can't see the screen. Mrs. Shen, can you see my screen?
Yes, I can see your screen, sir.
Miss Angela, I think the screen is live.
I can see it now.
Maybe you did not use your glasses before.
I'm my glasses. It
Okay,
didn't
yeah.
show it. Say, present value here is 38 minus 38. Is it the one you're talking about?
No, now see MPV now.
Okay, if you're negative 1.65 million. Okay. I can't possibly see any error here. I can't.
Because I see, we are not spotting error from that place. This year, this look at the information here. This is what I'm referring to. Is there any error here? In this one here, the one I highlighted in yellow. Look at what the information says and spot whether there is error there or not.
I think there is no error there.
There's no error, Abby?
Okay.
Yeah. No.
Essentially, depreciation is not the cash flow, and all the working capital is returned at the end of all capital being returned at the end of the project.
Take it from the beginning. Take it from the beginning.
It says working capital and depreciation have not been taken into account.
Good.
And present value calculation above. Since depreciation is not a cash flow, which is right, and all the working capital is returned at the end of the project. Normally, we are supposed to take working capital into consideration.
Mm-hmm. So, but they did not take it into consideration. Are they wrong or not?
They are wrong.
On what basis?
They are supposed to take it into consideration by.
But they've told you the reason why they did not take it into consideration.
Exactly, that's what I'm going to. When they said that the working capital is returned at the end of the project, so there's no.
For instance, I put 500,000 in the business at the beginning of the project, and at the end I'm getting 500,000 back. Negative, positive. Is it not going to net up to zero?
Yes, sir.
So that's the reason why they did not include it. Is that right or not?
It's right, sir.
Okay. Ms. Angela, do you support her?
So, because I need to look at the NPV, the computation, then look at it, marry it together. I cannot join them together. So I don't have any answer to give to this because I'm not too sure. I can't say what I'm not sure of.
You don't need, Mrs. Angela, you don't need to look at the NPV at all before you make a conclusion.
No, I'm talking about working capital and depreciation. I have not been taken care of. That means I need to see the.
You don't need to see anything. That's what I'm saying. You don't need to see anything. Look at it. Look at what happened here. Now, depreciation is a non-cash item, Abby, and it was not taken into account, right? This is correct. Good. Okay.
That's my question. Where is it not taken care of? Where is it? That's my question. Where's my
I went there to show you before now. If you remember, I went on to show you. They've calculated NPV here. See NPV here. I think I took you there before. Let me go there again. This NPV now, I brought you here before. Look at it here. The NPV they computed here, they did not consider depreciation. They did not consider working capital.
I can see it now.
You said?
I can see it now. Go ahead.
They are saying that this NPV that they computed here, they did not take account of depreciation and working capital.
Yes.
And the reason they gave is that, number one, depreciation is a non-cash item. And I have told you that anything that is non-cash item is not considered for NPV. So that is correct. The second one we want to test whether it is correct now or not is that normally I'm supposed to have working capital in this solution, but there is no working capital. And what is their reason? Their reason is this. The reason they gave is that, let me say year 0. Year 0. Year 5. When I started this project, I put in 400 million as working capital. That's negative, Abby. And of course, the rule of working capital is that whatever working capital you put in the business, you are going to recover it at the end of the project, right? So I'm getting my 400 million back. So they are now saying that since whatever I put in here, I will get it back at the end of the project life. So I don't need to include working capital because 400 minus 400 will be what? I say 400 minus, okay, it will be plus now because one is negative, Abby. 100 plus this will be what? Will be 0. Do you understand? This is what they said. That's the reason why they did not account for working capital in the solution. However, this treatment is completely wrong. Why? 400,000 in year 0 will be discounted using discount factor of year 0. Right? 400,000 in year 5 will be discounted using discount factor of year 5. So when you discount them, the two of them will not sum up to 0 again. Let us assume that we are using 10%. 10% year 0 is 1.000. What is 10% year 5? Quickly give me the figure. Mrs. Shew, what is 10% year? What is 10% year 5?
I'm not my calculator. Hold on, give me like, I'm coming.
Mrs. Angela, are you with your calculator? That should be 0. I think 0.683.
10% year 5, right?
Yes. 0.683 or so. Calculate it. Or 638.
Annuity factor?
No, now this comes for 1 year now.
0.621.
621.
Yes, sir.
So discount them. When I discount them, this will give me 400 million. Abby?
Yes.
What about the second one? I want you to know the reason. If you don't understand the principle of a topic, when they say question about that topic, there's no way we'll be able to answer it. If you don't know the principle. That's why I'm trying to build you based on principle, not on the figure I'm solving here. I'm not bothered with the figures here. No, at all. What I'm bothered about is you understanding it. The moment you understand it, my figures here are irrelevant to you. You understand? The way you understand it, my figures are irrelevant, completely irrelevant to you. Now, when you discount the 400 times 0.625, 6 to 1, we give you what?
248.
248.
Yes.
So, can they give you 0 now? Not equal to 0. Can you see that? Not equal. Not equal to 0. So, because of discount factor, if you go and say, maybe I will put 400 million at the beginning and I'll get 400 million back at the end, so I don't need to consider it's still going to give me 0. It's not going to give you 0, because if you do that, you have not recognized time value of money. Do you understand? You have not recognized time value of money. So that is a serious error.
So that means we need to recognize the working capital.
Of course, working capital must be recognized. It must be recognized. That's the question says, correct the errors made. The question says is, correct the errors made. Any error made in the calculation of the NPV, correct it and compute adjusted present value instead, because the question is not NPV question, it's APV question. Let us continue. So we have seen the note 7. Please and please, I beg you, my joy is if all of you pass this exam, I'll be much happy, honestly speaking. And for you to do so, it means you have a lot of work in your ahead of you. It's not enough for you to just listen to the video here and you think you know it. No. The video we are doing here is just a guide for you to go and apply the principle to solve many questions, so that you get used to those questions. Now, I don't forget I said I was going to solve a revision question. I will not solve the revision question with you. The reason is that what we are discussing here is what I pick also for the revision class, because all these, I pick them because they are likely examination questions. Okay, they are likely examination questions. So they are still the same thing we are going to see in the revision class. Instead, what I'm going to be treating with you is that the mock exams, okay, the mock, I'm going to, after you have solved it, and send me your solution, which I told you I'm going to send the mock to you end of October, by God's grace, end of October, I will send the mock to you. Then you still have two weeks. So you solve it, maybe before 5th or 6th or 7th, you could have finished solving it. Send me your solution. Then I will now organize a Zoom class where we are going to solve all those questions. Okay, I will do the questions for you, I will see. So that will be the final thing we are going to do before you go in for that exam. Okay, that will be the final thing we are going to do before you go in for the exam, because the mock exam is not, I didn't extract it from my material. It's entirely different questions, and we need to revise it. I need to revise them with you, so that should, in case you come across that question in the exam, it should not give you any form of threat at all. You just solve it and pass. Please, let us ensure that we practice as often as possible. As I may, I have sometimes I sleep 3 o'clock because I have so many I'm doing. Office work is there, FCA is there, young class is there, and I want to write I'm writing my ACCA in March as well. So all these things you can see. So I know you are all women, you have children to take care of, but nonetheless, you should still have to create time for yourself to revise your studies and then apply the knowledge gained to similar questions. Okay, you have Pathfinder there, you have other questions that you can lay your hand upon and solve questions and solve them so that you'll be able to build your confidence. Now you can see if this question is to be a live question, if I've not done it, I know you'll not be able to do it. Despite the fact that we have treated all those principles. You can see the way they just try to corner the principle and you don't understand it again. Everything looks strange to you. Yes, sir. So you must understand the time value of money very well, understand the time value of money very well, and know where a cash flow must be discounted and where it may not be discounted. So when you are dealing with time value of money and your cash flows will arise at a different time period, then they must be discounted using the discount factor of those years. All right, let us continue. It is anticipated that the project will be financed entirely by them. Mrs. Welcome, ma. Good evening, ma.
Thank you, sir. I was in church when you were calling.
You didn't see my message earlier.
I did not see it on time. I just saw it now.
Yeah, sorry. 1 minute, please. 1 minute. Okay, let us continue. It is anticipated that the project will be financed entirely by debt, 60% of which will be obtained from a subsidized loan scheme run by the government, which lends money at a rate of 100 basis points below the 10-year government yield rate of 2.5%. Look at it. You want to get a subsidized loan. And the question has told you that the subsidized loan is going to be 100 basis points. What is 100 basis point in percentage? What is 100 basis point in percentage?
1.
1. Now, we are going to get it at 1% below the 10-year government debt yield rate of 2.5%. So what's my cost of debt? What's my cost of debt? What's my cost of subsidized loan from that information?
1.1.
1.1.
I think 2.2 minus 1.1.
Where do you have 1.1? Where do you have 1.1? Shebi, you were going to answer this. I said 100 basis point is what? You said 1%. And this one is 2%.
Yes, 2 minus, you said below government 2.5 minus 1. You give us, sorry, I missed this.
It will give us what?
2.5 minus 1. 1.5.
So the cost of the subsidized loan is 1.5%. Okay. Now, issue costs related to raising the finance are 2% of the gross finance required. you can see. Can you remember this statement I showed you when we're doing what do you call it? When we're doing the framework of adjusted present value. You know, I made mention of gross, Abby, and I gave you formula for it. That's why I said that framework I gave you is very important. In fact, in your exam, if I see APV in the question, it means I should be jubilating because I will expect that you perform excellently well. The only aspect of APV that gives problem to students is the finance effect cash flow. And that has been effectively addressed by the framework I gave you. There is no how complicated the question will be on adjusted present value. The moment you follow that framework, everything will be easy for you. Now, the remaining 40% will be funded from Franco Limited normal borrowing sources. It can be assumed that the debt capacity available to Franco Limited is equal to the actual amount of debt finance raised for the project. What do we mean by this? What that information is simply telling you is that the gearing of Franco will increase to the maximum. That is what? The height of the debt capacity available. So taking this debt capital will raise the gearing of Franco to the maximum capacity. So it means financial risk is changing. In short, that's what it means. Financial risk is changing. Franco Limited has identified a company, Denko Limited. Now, because this is a diversification project, we need a proxy company. And who is the proxy company? Denko Limited, which operates in this. Mrs. Angela, can you mute yourself?
Okay.
Okay. Franco Limited has identified a company, Denko Limited, which operates in the same line of business as that of the project it is considering. Denko Limited is financed by 40 million shares, trading at 3.2 naira each, and 34 million debt, trading at 94 naira per 100. Denko Limited equity beta is estimated at 1.5. The current yield on government treasury bill is 2%, and it is estimated that the market risk premium is 8%. Denko pays tax at an annual rate of 20%. Both Franco Limited and Denko Limited pay tax in the same year as when profits are earned. Okay, are we told the cause of death of Denko? Okay. Now, we are asked to compute adjusted present value for this company. What do we do? Let's go do something on this.
So can we continue later?
Yes, I just want to start it, obviously, because I'll be having a class by 9 and I have to get to before that. Our, what do we call it?
Online
Telegram group. I don't know the traffic I'm going to face now on that terminal bill by this time. I just have to take people today. This question of the theater. No, I will soon round up. I'll be going home now. then Franco Limited. Now, let's just create our table. We have 1, 0, 1, 2, 3, 4. It has a 4-year life. Let me increase it by 1 in case. Okay, I'm going to shift it down. So just label 0, 1, 2, 3, 4. Okay, so now I want you to do something for me. In order to make solving this question easier, when we come back tomorrow, by grace. What is that? Go to solve this question. It's not difficult at all. Why? Because the template has already been given to you. This is the template you will follow. This is the template you are going to follow. Pick the sales revenue. Pick the sales revenue. Increase it by what? By the inflation rate of revenue. What is the inflation rate of revenue? 8%. So I will say year 1, 23.03 times 1.8 raised to power 1. This one times 1.08 raised to power 2. This one times 1.08 raised to power 3. Times 1.08 raised to power 4 rather. I do the same to direct project cost, which is 4% inflation. So this one raised to power 1, raised to power 2, raised to power 3, raised to power 4. Interest is not allowed. So interest should go. We are not including interest. You can see. Just two things. You are already in your operating profit. Then go and compute your capital allowance. Deduct it from operating profit, you get profit before tax. Charge your tax at 20%, you get profit after tax. So I want you to compute it up to profit after tax, so that tomorrow, when we are doing it, you can be confirming your figure. It's not because of me. I just want to know whether you know how to apply the inflation rate, and that is what I've just explained. So go and get them done before tomorrow. Just play. It can't take you more than 10, 15 minutes for you to get to that level. You understand? So get to where you compute your tax, and stop there. Profit after tax. I want to see your profit after tax. So we continue from there tomorrow by God's grace.
All right, sir. Thank you, sir.
Mrs. Chiwe, Mrs. Angela, we are meeting tomorrow, but I'm going to communicate like I did today. Please watch out.
What did you say, sir?
We are meeting tomorrow by God's
Okay,
grace.
tomorrow.
And I'm going to communicate to you the way I communicated today. The reason being that my schedule is not determinable for now, to be sincere. I can't say this is what the time we're going to meet. But when I study the situation tomorrow, I will communicate to you ahead of time. Are we fine?
Why don't you be doing it like from 7 o'clock upwards?
From 7 o'clock?
Yes, now.
Madam, if you did Lagos, if you did Lagos, you don't go talk like that too.
Because yesterday, she called me now around almost 9 o'clock. I thought maybe it's the time that will be suitable for you.
Except you want us to do it this way.
She told me that you wanted to start the lecture.
Now look at it. If this how it can run. If I leave office by 5 or 5:30 or 6, I can see if there is no serious traffic. I can still get home 8:30. If you people are ready to do class by then, I can even take you to 10:30 or 11.
It's okay now.
It depends on you. It depends on your agreement. If
Not
you can
just
agree
me,
that,
every other person.
that's why I say your agreement. That's why I say your agreement.
Okay.
You miss everybody now.
That time may not work for me. Or that late night hour may not work for me.
So we are good. That's going to be time. So it's going to be in the evening. I'll take you in the evening by God's grace tomorrow. And of course, I've told them before you join the class that we're also going to meet on Friday. May God spare our lives. So we are holding 3 classes this week. We have completed the first one today, next one tomorrow, and next tomorrow we are going to hold another class by God's grace, so that we can cover our lost time on Monday. Are
Please
you
don't
fine?
share the notes.
Okay, maybe I'll just share before I leave my office now.
And this video, if you can get it today.
No. Even the Zoom will not even release the video now. It's like after 30 minutes, it will now drop.
Okay.
You understand? After 30 minutes, they will alert me that it has dropped. Then I cannot go and download. I will have to download first, upload it on YouTube before sending it. So that will be tomorrow, because I will lecture from 9 to 11. So I will be tired. Before I get to lecture till 11 o'clock, I won't be able to do anything again. But we'll get it tomorrow by God's grace. I will share the note now. Thank you.
Okay, sir. Bye.